Cryptocurrency has become one of the most exciting and controversial investment opportunities of the modern financial era. Over the past decade, digital assets such as Bitcoin, Ethereum, and thousands of other cryptocurrencies have generated incredible wealth for some investors, while causing significant losses for others. Stories of people turning a few $100s into millions have inspired countless newcomers to enter the crypto market, hoping to achieve similar success. At the same time, headlines about massive price crashes, exchange failures, scams, and market volatility have reminded investors that cryptocurrency remains one of the riskiest asset classes available. The truth is that most investors who lose money in crypto do not fail, because cryptocurrency itself is flawed. Instead, they fail because they repeat the same costly mistakes over and over again. While there are many different investing errors, one mistake stands above the rest, because it often leads to poor decisions, emotional trading, unnecessary losses, and missed long-term opportunities. Understanding this mistake and learning how to avoid it could dramatically improve your chances of becoming a successful cryptocurrency investor. Today we will talk about the biggest crypto mistake 99% of investors make. So, before we start, make sure to hit the like button and subscribe to my channel. The biggest mistake is investing with emotion instead of strategy. If there is one mistake that causes more losses than any other in cryptocurrency investing, it is making decisions based on emotions, rather than following a carefully planned investment strategy. Fear, greed, excitement, panic, and impatience often influence investor behavior far more than logic or research. During bull markets, many people become convinced that prices will continue rising forever. They buy cryptocurrencies simply because everyone else appears to be making money. Then, when prices eventually decline, those same investors panic and sell at significant losses. This emotional cycle repeats in nearly every market cycle and has cost countless investors enormous amounts of money. Fear of missing out drives poor decisions. One of the strongest emotions affecting crypto investors is the fear of missing out, commonly known as FOMO. When Bitcoin or another cryptocurrency begins rising rapidly, social media fills with stories of overnight profits. Friends start discussing their investments, news headlines celebrate record-breaking prices, and influencers predict even higher valuations. Many investors rush into the market without understanding what they are buying, simply because they fear being left behind. Unfortunately, buying after dramatic price increases often means purchasing near market peaks, rather than attractive long-term valuations. Panic selling during market corrections, the opposite of FOMO, occurs when markets decline sharply. Cryptocurrency prices are well known for their volatility, and temporary declines of 20%, 30%, or even 50% have occurred multiple times throughout crypto history. Investors who entered the market without a clear plan frequently panic during these corrections. Instead of viewing market declines as a normal part of investing, they sell out of fear that prices will never recover. Many later watch prices rebound after locking in permanent losses. Not understanding what you own. Another major mistake involves investing in cryptocurrencies without fully understanding their purpose or technology. Many investors purchase digital assets simply because they appear on trending lists, or because someone online recommended them. However, every cryptocurrency serves a different function. Some focus on decentralized finance, others on smart contracts, privacy, gaming, artificial intelligence, supply chain management, or cross-border payments. Understanding a project's technology, development team, adoption, security, and long-term use case provides a much stronger foundation than relying solely on price predictions. Chasing quick profits, many beginners enter cryptocurrency markets believing they can double or triple their money within weeks. While extraordinary gains have occurred in the past, they are not guaranteed and often involve significant risk. Constantly chasing the next 100x coin usually leads investors towards speculative projects with weak fundamentals. Successful investing is generally built on patience, discipline, and long-term thinking, rather than attempting to predict short-term price movements. Ignoring risk management. One of the biggest differences between experienced investors and beginners is how they manage risk. Many new investors place all their available money into one cryptocurrency, believing it will outperform everything else. While concentration can increase potential returns, it also dramatically increases risk. Diversifying across multiple high-quality investments helps reduce the impact if one project performs poorly. Risk management also includes investing only money that can remain invested during market volatility and avoiding excessive borrowing to purchase cryptocurrencies. Believing every social media prediction has become one of the primary sources of cryptocurrency information. But not every prediction is based on careful analysis. Influencers, anonymous accounts, and self-proclaimed experts frequently make bold claims about future prices without providing evidence. Some individuals may even promote projects they already own in hopes of driving prices higher. Investors who rely entirely on social media often make emotional decisions instead of conducting independent research. Forgetting about security, protecting cryptocurrency investments is just as important as choosing the right assets. Cybercriminals continue targeting crypto investors through phishing attacks, fake websites, malware, fraudulent investment schemes, and compromised exchanges. Investors should understand wallet security, strong passwords, two-factor authentication, and the importance of protecting private keys. Losing access to a cryptocurrency wallet can result in permanent loss of funds. Trying to time every market move, many investors believe they can consistently buy at the exact bottom and sell at the precise top. In reality, even professional investors rarely achieve this consistently. Cryptocurrency markets move quickly and often react unpredictably to economic news, regulations, technological developments, and investor sentiment. Constant trading increases emotional stress and often leads to mistakes. Many long-term investors instead focus on gradual accumulation through regular investments, rather than attempting to predict every market movement. Dollar cost averaging can reduce emotional decisions. One strategy many investors use is dollar cost averaging. Instead of investing a large amount all at once, they invest fixed amounts at regular intervals, regardless of current prices. This approach reduces the pressure of trying to identify the perfect buying opportunity, while helping smooth out the effects of market volatility over time. Although dollar cost averaging cannot eliminate investment risk, it encourages discipline and long-term consistency. Ignoring the bigger economic picture, cryptocurrency prices do not exist in isolation. Inflation, interest rates, economic growth, government regulations, institutional adoption, global liquidity, and investor confidence all influence digital asset markets. Investors who focus only on cryptocurrency news while ignoring broader economic conditions may overlook important factors affecting future price movements. Patience has historically rewarded long-term investors throughout cryptocurrency history. Many of the largest gains have gone to investors who remain patient through multiple market cycles. Bitcoin, for example, has experienced several dramatic declines before eventually reaching new highs. Although past performance never guarantees future results, history demonstrates that emotional reactions during temporary downturns often prove costly for long-term investors. If you like this video and would like to see more like it, please give it a thumbs up, leave a comment, and click the button to subscribe.